If you could only pick one dividend ETF to hold for the next decade, what would it be? Well, some popular choices include SCHD, CGDG, FDVV, and DGRO. So, in today's video, I'm going to do a 2026 dividend ETF showdown and briefly talk about how they've performed, what are some 2026 price targets, and which dividend ETF deserves a spot in your portfolio. Okay, so let's talk about performance. Year to date, you can see that SCHD in blue has surprised a lot of investors. I mean, it's up over 15% or 3x its peers. But if we zoom out a little bit to the 1 year time frame, you can see that CGDG, which is a lesser known dividend ETF, is actually up top. Now, looking at the 5 year return, FDVV is up a whopping 105%, and a lot of that is due to its exposure to the tech sector. Now, if we switch gears and look at dividends, in particular dividend growth rate, you can see that gold standard funds such as SCHD and DGRO have actually not done so well. I mean, if you've held these funds for more than 5 to 10 years, you're probably used to somewhere between a 7 to 10% annual dividend growth rate. So these dividend growth rates are a little bit disappointing, but 1 to 2 years does not make a bad fund. I think that these funds still have a lot of positive upside, and we'll see what 2026 brings us. Now, if you look at two other funds, CGDG and FTVV, they've actually had a phenomenal year. And if they can keep up this type of dividend growth rate, anywhere between 9 to 12%, I think they may actually dethrone SCHC and DGRO. But a lot of factors that are connected to this are its rotation to value. Maybe some sectors within these portfolios will heat up and others will cool down. And also the portfolio reconstitutions, which will happen for some of these funds in the next couple of months. So those are some things to pay attention to because they will also affect price targets for 2026. Now, a lot of the performance for some of these funds will have to do with its underlying holdings. And if we start with SCHD, one of the reasons why SCHD has done pretty well is its underlying holdings, especially in the top 10, are pretty green. I mean, it doesn't have a lot of exposure to the tech sector, which has been taking a big beating recently. So if your portfolio has tech, you're probably in the red a little bit. Now, if we look at some price targets for SCHD, around its current price at the time of this recording, $31.61. That's about a 3% upside to its average price target of $32.58. I'm actually hoping that it won't reach this price target too fast because I'd still like to pick up a few more shares, somewhere between $27 and $30. But we'll see what happens around the portfolio reconstitution and some of the macroeconomics that might actually affect this in the coming months. Okay, moving on to CGDG, you can see that there's a lot more red in this portfolio, and one reason is it has more exposure to the tech sector. Fortunately, this fund also has some exposure to real estate and financials, and so you can see some green in this portfolio. Now, looking at the current price, around $37.69, that's about a 9% upside to its average price target of $41.20. But let me tell you, looking at this fund for the last 2 years, it always surprises me how much capital appreciation can happen. I mean, I remember seeing this fund at $28 last year, and it's already close to $37. So I'm actually not going to be surprised if it hits the highest price target of $48.70. So we'll see what happens in 2026. Okay, so let's look at FDVV, and you can see that this fund has a lot more red than any of the ETFs we've talked about so far. And the biggest reason is this fund is more tilted to the tech sector. And that's the reason why it's outperformed in the last 5 years, because tech has done pretty well in the last 5 years. So a lot of Mag 7 names are down right now. Fortunately, this fund does have some exposure to healthcare and consumer cyclicals. So if you think that the tech sector is going to rebound and there's no AI bubble, this actually might be a pretty discounted fund to start investing in for some investors. Now, if we look at the price target, it's currently around $59.11. So that's about a 14% upside to the average price target of $67.72. So I think this has the most upside out of all the funds we'll talk about today, but it's also a little bit more risky in this current environment. So we'll see what happens in the coming months. Okay, so moving on to the last fund, DGRO. And one thing you'll notice about this fund is it's a better balance of green and red. And one reason is it just has more holdings in its portfolio, close to 400. So it avoids concentration risk, and because of that, it'll never finish first place in the dividend ETF race, but it also won't finish last place. So it has a pretty decent exposure, and I think that's why this fund has been popular amongst dividend investors. Now, if we look at the price target, it's currently around $73.62. So that's an 11% upside to its average price target of $81.79. Okay, we've just talked about some price targets from four popular dividend ETF funds. So the big question is, well, which dividend ETF deserves a spot in your portfolio? And I can't answer in a one size fits all answer because a lot of it has to do with what's already in your portfolio, what are your portfolio goals, and where are you in terms of progress towards those goals. So some factors that might affect which portfolio or which ETF belongs in a portfolio could be related to capital appreciation. Are you still in the wealth accumulation phase or are you in the wealth preservation phase? And that has a big impact on which ETF is best for your portfolio right now or in the near future. Other factors include, dividend growth rate and how much portfolio allocation you have to certain sectors. So when we look at these four funds, probably the best answer is it's not good to just pick one, but actually have a couple. And actually, many investors do have more than one of these funds in their portfolio. But the risk is some investors might accidentally double down on the same stocks because some of these funds have similar stocks in their portfolio. So in order to avoid doubling down on stocks that you actually don't have a lot of conviction in, I'll be looking at a hybrid investment strategy to figure out which two ETFs are more complementary than others. But before we do that, just a little disclaimer. This video is for entertainment purposes only. It is not intended as financial advice. Please consult with a qualified financial advisor before making any investment decisions. Okay, so let's look at this hybrid investment strategy. And you've seen this on YouTube a lot. If you watch Eugene Vasquez, you probably have seen this on some of his videos as well. But essentially, the main idea is that you have your core holding make up about 60 to 80% of your portfolio, and your satellite positions make up anywhere between 20 and 40%. And again, this really depends on where you are in your investment journey. Now, if you look at what's in a core holding or core position, usually stable ETFs that have broad market exposure and prevents concentration risk, something like DGRO. And these are funds where you don't have to check your portfolio every day. You can sleep well at night because you know they're going to be okay by itself. Now, if we look at satellite positions, these contain higher growth potential or slightly riskier positions. But they do offer some tactical exposure. You might be able to follow some trends and some things that may be pretty good to invest in the short term. Now, these funds also afford some flexibility, meaning that you don't have to hold them for the long term. Maybe you can hold them for 1 to 2 years and then rotate when the market really tells you to. Because sometimes, this year, next year, this sector is really hot, and then the next few years, this sector is really cold. So having some positions in your satellite being flexible, you go in and out every few years, whereas the core positions, you want to hold them for the longevity of the portfolio. Now, looking at some positions here, the first one we'll look at is SCHD and DGRO. And this is a popular combination, and we can see that it has about an 18% overlap. So not that great, but not bad either. And in many ways, they do complement each other. You can see that where SCHD is a little bit heavier in energy and staples, DGRO does have some exposure that SCHD is missing, such as technology and utilities. Now, if we look at the performance, what I did was I used DGRO as the core and SCHD as a satellite for the DGR core one. And then I used SCHD as the core and DGRO as a satellite. And interestingly, if we look at the data, if you had DGRO as your core and SCHD as a satellite, you actually did a lot better than the other way around. I mean, starting 10 years ago with $10,000, you would have about $30,000 today, which is not that much more than the SCHD core, but it's something interesting to note. Now, if we look at two other funds, FDVV and CGDG, and right now this means FDVV would be the core and CGDG would be the satellite, you can see that they're actually complementary. I mean, a lot better than, let's say, SCHD and DGRO. There's only 10% overlap. The only thing about these funds are there's a higher, exposure to tech. So depending on how tech is in certain years, you might really outperform or you might not. But I think these are complementary. And if we look at the performance in the past couple of years, looking at DGRO and SCHD as one portfolio, and FDVV and CGD as another portfolio, you can see that FDVV has really outperformed DGRO and SCHD. And if we look closer in detail, 2 years ago, if you started with $10,000, you'd have about $13,700 with DGRO, and then $14,500 with FDVV. So that's a pretty big difference, just considering only 2 years. So if you zoom out 10, 15, 20 years, that could be a really big difference. Again, CGDG is still a new fund, so there's not a lot of data points yet. So if you're interested in, looking for a fund that might be potentially better or more, I would say, higher performing than SCHD and DGRO, CGDG might actually offer some investors a pretty good option. Now, if we look at one more holding, and this is SCHD and CGDG, I looked at a lot of data and it's not that much different than some of the other funds I've talked about so far. But if we look at the overlap by weight, only 6%. So pretty good. And I think that this combo might be the best complementary combo in the next 5 to 10 years. But again, CGDG is still a newer fund. We'll have to see what happens in the next few years. Okay, to finish off this video, we'll do a short recap. So for core positions, I think DGRO, which is boring but consistent and effective, and FDVV, which has been the momentum king and dividend growth leader the past few years, I think they belong in a core position in a portfolio. And the other two are more satellite positions because they have smaller holdings, they're newer, and they just don't have a lot of diversity. So CGDG, I think, is a better satellite position than a core position. It is still a wild card because it's only been around for a couple of years, but I think it is an active challenger and something to watch for the next few years. Now, SCHD might reclaim its gold standard status as the sectors where the market rotates to value, so that'll be something to look out for in 2026 and 2027. Okay, so that was episode number 6 of my Dividend Fast Pass series, 2026 Dividend ETF Showdown. Hope you got a lot of value out of this video. I do make other videos on financial freedom and living in Asia, so please like this video and subscribe to watch more free content on achieving financial freedom and living in Asia. And you also might like these 2 videos. Thanks again for watching. Take care and see you in the next video. Peace.